From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hi, good morning. It's Friday, July 29th. You're listening to the Macrocast. I'm Tony Fratto with Hamilton Place Strategies with our partners bringing you the Macrocast from Markets Policy Partners, John Fagan and Brendan Walsh. And we are really lucky today to have with us Howard Schneider, the Fed reporter for Thomson Reuters. Howard, welcome to the Macrocast. It's great to have you here.
Thanks.
Yeah, you had a busy week. We're going to get into a lot of your stuff. You had Fed meeting and GDP, and we have and we got more inflation numbers this morning, and I also want to talk to you about a story that you wrote yesterday. You posted yesterday about Fed policy and food, and how
weird, right?
Yeah, exactly. There's just so much to get into there, and so we're really excited to talk about it. I'm really excited to have you on the show with us. But Brendan, you want to give us the prints from this morning on spending and inflation and the freshest numbers this morning?
Yeah, so we got a host of both spending and inflation data. So personal spending was up 1.1% in June, while income was up 0.6%. But then also within that report, we get the Fed's preferred inflation measurement, the PCE price index. And a lot of that data comes from the CPI. It has different weights. So, we had a decent idea what it was going to be, but it still did come in higher than economists' expectations. The price index was up 1% from a month earlier, which put it up 6.8% from a year earlier. And then the core, which strips out food and gas, which we're going to talk about food after this, that was up 0.6% higher than expected, which puts the core PCE price index up 4.8%. We also then got the employment cost index, which this one might be actually a little more important for the Fed in terms of their thinking. It's new data. The inflation data is kind of, it's like I said, it a lot of it comes from the BLS, and then it just has different weightings. But the employment cost index for the second quarter, wages were up 1.4%, and employment cost with benefits was up 1.2%. So we're not quite seeing the monetary policy tightening massively slowing wage gains as of yet,
or not at all, even, right? I mean, if you were looking. Now, if you were looking for, signs that, signs of that inflation had peaked, we don't get that yet, right? I mean, that's not. I think that's we're still running. At least looking backwards, we're still running pretty hot.
Yes, definitely. I mean, there are some indications with shipping rates and commodities are coming off, like copper's down and things like that, but that's the first level. The second level has to kind of seep into the employment factors, and job gains still seem to be strong, though we are hearing more and more companies saying that they're going to either slow hiring or actually start to lay people off. And then then once that happens, then we see the wage gains start to slow.
Yeah, July non-farm payrolls next Friday is going to be a big number. That's big in terms of lots of attention and potentially market moving. Expectations are for continued resilience. So it'll be one to watch for sure.
The mother of all jobs reports.
Yeah, so consensus is kind of for around 250,000 jobs, which I guess that's a little more normal pace. That goes back to the pre-pandemic recovery rate. So we'll see,
Yeah, absolutely. Howard, the numbers this morning, I mean, do you think, I saw, someone who sits near you in the press room for FOMC meetings, Neil Irwin, said that he thought those numbers will cause heads to turn at the Fed, and not in a good way. I mean, is that, they're certainly not welcome over there this morning, right?
Yeah, I think there's a couple things. The month-to-month pace, they all say they're watching that for some signs of it coming down, so we're not getting any reliefs there. And I think that if you look at, it was interesting in the press conference Wednesday, Chair Powell pointed back to the June SEPs as the best guidance we got right now. And that gets you up to a 3.5% federal funds rate at the end of the year, contingent on a path for PCE. And given the numbers today and what we saw in the second quarter and what we see with ECI, it was still pressure building. Those numbers are going to have to absolutely collapse over the next 6 months for them to hit their S&P target. So implication, the contingencies for that rate path they mapped out in June are already falling apart. Powell said that as much at the meeting. Inflation came in, CPI came in higher than expected, growth was weaker than expected. But what we saw today is, I think, a little more towards 75 than back to 50.
And we're going to get more data, before then, in August. It was something I wanted to get into.
Well, we're going to get a ton of data. We're going to get all the July and all the August, because the meeting isn't until September.
Summer break, guys. Come on.
No. So when the Fed says we're data dependent, this time it's probably more true than ever, because the economy could look totally different in when they sit down, in mid-September to do this, because we know monetary policy works with a lag, and we're seeing that in the housing market. Housing activity has fallen off a cliff. We're seeing, well, oil prices are still up, but commodity prices are coming off. So the world could look totally different one way or the other. Maybe inflation stays high and they have to do 75, or maybe things really, really do slow down and they end up doing a lot less.
I do think it's weird. I mean, we have like this whole, no meetings in August is, it just goes back to pre-air conditioning days in Washington, D.C., right? It's literally the only reason why there isn't a meeting in August is because, Washington, D.C. would empty out. Congress goes out, even like Congress has this bill, right? The pressure, they have to pass it because they have to go home for recess in 10 days. And so that's it. And you can't stay. You have to go home, because no one could be in August in Washington in August. That's kind of where the Fed is. And I just think, to me, it's kind of old fashioned and weird that they're not. But but Howard, you can make the case that you don't want to overreact on data also, and give it a little time. I mean, if they had a meeting in August, I guess they would have to do something, right?
Yeah, I think. I actually think Jay Powell is kind of relieved not to have a meeting 6 weeks in front of him, even though it's only 2 more weeks. It could make a world of difference, and frankly, I think it lessens the possibility of having that extra time. A little bit less likely to make a mistake that they can't reverse. And if you look at the way his communications have evolved since March, really, and for three meetings in a row, he was very explicit about what was going to happen next. And eventually it got him in trouble. And particularly it got him in trouble when there was important data, an inflation report that fell within a couple of days of the upcoming meeting, and they had to scramble and change expectations on a dime. It wasn't a good look for them. So having that extra 2 weeks, a full 2 months of data, that could make a big difference. And I promise you, speed may be important here. They need to be nimble. They need to be quick. Right? Jumping over the candlestick or whatever that rhyme is. But I think this time they're really happy to have that extra bit of time and that extra round of data in hand.
I agree. I think it's silly that we don't do anything in August, and it just goes back to, like you say, it's really hot in DC. But the way that it's playing out for the Fed now, I think, like Howard said, it's ideal, because it allows them to see the data and not have to overreact and to take their time.
And Jackson Hole's in August. And that we had a great conversation with Megan Green the other day, and she referenced that it is going to be, that's sort of the stand-in, I guess, for the August meeting these days. And it will be interesting if the Fed is trying to change its messaging. That's really the place, that's been the venue traditionally over the past decade or so, where large scale monetary shifts have been announced. It doesn't seem like that. It seems like the Fed is pretty locked in. But we saw a hint in this meeting of of a more balanced, at least slightly more balanced growth and inflation risk mix.
Man, I did not hear the growth hint that some people are taking. I part ways with you a little bit on that. I think he had 6 opportunities in that press conference to talk about growth. And he always came back to, we are going to kill inflation no matter what it takes. And interestingly, I think that when he spoke of sort of the pain people are feeling, it wasn't about joblessness. It was about inflation. It was about inflation curbing their purchasing power and making life tough on people. And that this frame he put around the issue back since November now, that the path to full employment goes through taming inflation, remains the operative thing. So yeah, growth has got him concerned a little bit, but I think it's frankly the signs of slowdown now are signs of the type of good slowdown, the Goldilocks slowdown, as it's been put. I think you'll put that today, is what's developing so far, quote unquote.
That's a really important point, because the equity market certainly is taking it the opposite. They viewed it as, we're going to get a pause in September, and especially the growth sensitive stocks like the NASDAQ are massively outperforming for right or wrong. So we could be in for a bad surprise. As the Fed presidents now next week will start giving speeches and clarifying. Yeah.
Well, I do think that's one. Again, if you go back to how this whole discussion has evolved, one risk that Powell has courted in not giving guidance is he has given an open field to the Reserve Bank presidents, and particularly some of the more outspoken ones like Jim Bullard, to just try to find a gap to run through. And if you look back in March, how much gamesmanship was going on over 25 and 50 with Bullard and Chris Waller, really openly, it seemed, pushing the committee towards 50. Trying to set expectations in the market around 50. And, Powell ultimately squashed that by going into Congress and saying, it's going to be 25. Well, that was that. Now there's no anchor. There's no anchor from the chair. So it'll be really interesting to see how, as the data evolves and the Reserve Bank presidents react to it, how that maps into market action and whether they end up getting backed into any kind of corner one way or the other.
Hey, Howard, will you be in Jackson Hole this year?
Yes, sir. Yep.
What do you know what do you actually, it might not be bad to hear your, do you have a what's your expectation for Jackson Hole, and do you know anything about the agenda?
Well, so the agenda is kept off the record until they open the thing and bang the gong and show you who's there. I expect we'd start to see, popping up on the Fed calendar at some point, who's going to be attending. Yeah. I think this is going to be a very fulsome discussion around all of the pandemic issues. I mean, just think of what the economy and what macroeconomics and what monetary policy has been through the last 2 years. I think it could be a very consequential symposium.
Yeah, I think you're right. We're one of those really big inflection points for real monetary policy scholarship, and just really looking forward to what comes out of it.
Yeah, and interestingly, just on Wednesday, we already heard the chair sort of in hindsight dial back one of the key steps he made during his tenure as chair, which was all that strict forward guidance around the new framework. He said, I'm not sure I would have done that. So that was considered his signature achievement, putting that new framework in place. And the guidance issued just after Jackson Hole is what operationalized it. And now he's saying, it was, maybe the wrong set of restrictions, maybe the wrong language for the wrong moment.
Shifting Fed banks, but ECB is essentially saying the same thing.
Yep. Yeah. Forward guidance is in crisis, as they say, one or two commentators.
That's two Fed banks, so that qualifies as a forward guidance recession. So
yeah.
Hey, Howard, can we take a minute and talk about your story yesterday? Because I do think it's super important, and I don't even know if you know this, but I do a lot on food. So you're addressing food, and I'm board of World Food Program USA, and so I'm always thinking about the cost of food and nutrition for people. And I just thought it was a really interesting perspective from you, and with respect to the chairman's views on how inflation is impacting real families.
Well, I was trying to kind of connect a couple dots, sort of on the fly yesterday, and I thought that his language in the press conference that we're seeing a real decline in food consumption really leapt out in my mind, stuck out. And my first thought was, is he actually like measuring calories and actual eating consumption here? Or have they got some study on that, or are they talking about consumption in economic terms, in terms of food being purchased? Well, I think, frankly, it turns out both things are happening. You saw the GDP report yesterday. There was a big whack to GDP on declining real food purchases, $33 billion to the downside. So that the implication there is that people are walking out of stores with less in their basket. And then if you go over to Census Household Pulse surveys, the change in food scarcity since the low, which was actually hit during the pandemic because of all the aid that was, coming through the pipeline, then back up, way up in terms of the number of households. 8%, now we're up to something close to 12. So the high during the pandemic was 13. So that's a marked increase in the number of people reporting that they're in a household where there's often or sometimes not enough to eat. So in terms of Powell talking to the American people about the real costs of recession and of inflation, and why it's important to get control of this, that's a very tangible example of how this is impacting families, and it's real. It is a real thing.
Howard, did you get a chance to see where that data was relative to pre-pandemic and big safety net support levels?
Yeah, good. So the household pulse was only started in response to the pandemic. So that survey dates to mid 2020, something like that. So I guess the question would be whether or not there's any way to correlate that with some of the Fed household surveys that go back that have a longer timeline. And I will tell you, it's going to be interesting. They do this thing called the Survey of Household and Economic Decision Making that comes out quarterly, and the last one, which was for the first quarter of this year, I believe, had one of the strongest readings for household sentiment and financial wherewithal on record. Okay.
Yeah.
I'm not sure the next one's going to hold up, because you look at, again, some of those indicators in the census surveys on trouble paying usual bills, for example, that's gone from roughly 25% last year to 40% now. Wow. So people are struggling, I think, across the income distribution.
Well, Howard, thanks for addressing it that way. I think you're right. It's something we're definitely be paying attention to quite a bit. We were paying attention to Walmart's earnings report also, where they talked about the shift in consumers also, and you get a sense that some of the bank presidents, when they reported earnings, talked a little bit about this also. So it is the thing to watch right now more than anything, how the consumer holds up, and again how it looks relative to pre-COVID levels also, because I do think sometimes context is skewed by COVID support levels. And by the way, I think I want the number of people struggling to put food on their table to be zero. To me, that's the right number. So it's not I think the pre-COVID number is a good number too. I just think just for context, we like to take a look at that. Hey, can I ask you about something else that the chairman mentioned said at his presser, and he got some criticism for it too. Was on this, he had made he reflected that, we're somewhere near the neutral rate on the policy rate. And Larry Summers and I think some others maybe took issue with it. How did you take his comment on that?
So I think this gets confusing for a couple of reasons. They have in their quarterly projections long run federal funds rate they pencil in, and they've all been using that as a shorthand for the quote unquote neutral rate, which is kind of an equilibrium concept where they're neither helping the economy or hurting it. They're just kind of in the background with credit conditions, and then people can make economic decisions based on, does that project seem profitable? Does that car seem attractive? Whatever. They're not really encouraging you to buy the car or discouraging you from buying the car. Now, the problem is, to understand that rate, it also depends on the rate of inflation. And that isn't really factored in there, except implicitly, that the neutral rate they put in for the long run is contingent on them meeting their inflation target of 2%. Well, inflation's not 2%. It's double that or triple that or quadruple that, depending on the measure you use. So it really isn't the short run neutral rate that would do anything particular to the economy today. So when he uses that 2.5%, it's really shorthanding through a lot of stuff that would be hard to explain in the course of a press conference. It's a benchmark. They throw it out there. I think Larry Summers is right that in the short term, it's not really the neutral rate. It's a shorthand for a concept that they've all kind of agreed to use as a benchmark.
Hey, John and Brendan, do you think market participants, took some, when we were talking earlier about the sense that maybe they could see at the end of the road where where the terminal rate might be, and that the Fed was concerned about growth, that comment fed into market participants' belief on that?
Yeah, I think that's fair to say. There was just an enormous amount of sensitivity to any hints of that kind of concern, just even on the margins of the Fed, and I think that's the way financial markets operate. They will, if given an inch, very often they will take a mile, extrapolate, and so forth. When you look at futures markets, it shows the Fed getting up to 3.5 or higher at the end of this year, and then rate cuts beginning in the spring. And so the market is telling, the message there is that they feel as though the Fed is making a mistake. And whether that's right or not, that's certainly the way the shape of the futures curve for Fed funds futures is looking. Now that's putting a lot of attention on the possibility that the Fed, maybe moderates its pace to the upside, and then tries to stick the landing with a little more of a balanced approach. Rightly or wrongly, that's certainly what the markets seem to be focused on.
Hey, the other, we talked a little bit about it, but the other, obviously the, giant data print we got this week was on GDP. And I don't really want to get into, too much about it. I mean, I would like to be the only podcast that this week that isn't debating whether it is or isn't a recession. But was there, if you crack open the data, and were there surprises in there? I mean, you mentioned one of them, Howard, on how food and household spending, but were there other things that surprised you in the report?
I think one thing that wasn't reported quite enough is how much the strong dollar detracted from it.
Yeah. The observation I would make is that, and this happens a lot, I think, in particularly in Fed land. You talk about one-off things, and Q1 got dismissed because it was all about imports, and that was good because we like imports. They help the economy, and we have inputs for goods, and they're cheaper, whatever. This time it was inventories. When you start adding up, if you get too many one-off things in a row, and now weakening consumption may take over from all of this, it ends up becoming the trend. And I think that's kind of what we're in a situation right now, where weakness may be handed off from one component of GDP to the next. And then who knows, people start thinking that way. As Robert Schiller says, they start acting that way.
Yeah, it's interesting because when things, when GDP is increasing, when you're in expansion, it seems like the different story in each GDP report is a handoff of strength to strength. As you can, right, there's always a new positive thing that you can grasp onto to describe why growth is happening. And to your point, maybe it's looking like we're a daisy chain of weakness to weakness for one reason or another, or weak story to weak story that you can.
Right. Go back to 2014-15 with Janet Yellen talking about inflation and why it wasn't getting up to 2%. And first it was pharmaceuticals, and then it was cell phone contracts, and then it was another thing and another thing. And pretty soon they're looking at the expectations data and they're diving away from 2%. So that's, eventually things reinforce the psychology, for good or ill.
Yeah, I agree. Okay, guys. Well, so next week we have, as we talked about, we have non-farm payrolls and household survey and
the JOLTS, the Jobs and Labor Turnover Survey, which is becoming a very important data point for monetary policy.
I'm really interested in seeing JOLTS. I usually don't pay that much attention to it, but I'm definitely very interested in seeing it next week.
Take a look, by the way, talking about the pandemic and sort of aftershocks. Take a look at a JOLTS map by state against state unemployment. The spread from some states at the low end, which are near parity, to others which are at 3 or 4 to 1.
We would definitely love to look at that mapped out. It's a really interesting story, and again, can't forget that this is a country of regions of sometimes pretty wildly disparate speeds in their economies. All right, guys, great show. Howard, thanks so much for joining us this week. I would love to have you back one of these days.
Anytime. Thanks for the invite.
Yeah, you've got
nice to meet you.
You've got a lot of you have some very interesting times ahead of you. I think there's going to be some a lot for you all to get into, especially
not that interesting, I hope. April 2020 was interesting. I don't need that interesting anymore.
Good point. Well, I would love for it to be sleepy. I miss the sleepy days of the Fed.
Yeah.
John, Brendan, great show, guys. Have a great weekend, everyone.
Bye-bye.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.